June 10, 2026, FinTech and Finance Infrastructure Briefing. From space-age banking to always-on markets, 5 big shifts reshaping finance now. In corporate treasury and cash flow management news, finance chiefs are seizing a unique moment created by a high-interest rate climate and powerful new technologies. After years of near-zero returns, corporate treasurers suddenly find short-term safe havens generating meaningful yields on idle cash. 6-month U.S. Treasury bills currently offer around 5%, compared to near zero just a few years ago, a sea change that's boosting companies' interest income and shoring up liquidity reserves. With global markets still in flux, CFOs see their responsibilities expanding from guardians of cash to strategic navigators of the enterprise. Many are likening today's treasury function to a financial control tower, providing a 360-degree view of risk and opportunity in real time. Some CFOs even half-joke that their teams are ready to manage cash flows for future off-world business operations if needed, a sign of the innovative spirit now permeating the field. Forward-thinking CFOs are leaning heavily on artificial intelligence and automation to interpret complex financial data and dynamically forecast cash needs. Where static spreadsheets and monthly forecasts once sufficed, many firms are deploying AI-driven analytics platforms that integrate data from bank accounts and enterprise resource systems to provide near-instant, continuous cash visibility. These intelligent systems flag anomalies, optimize working capital across currencies, and even suggest strategic moves, anything from timing debt issuance to reallocating surplus cash into safe short-term bonds, at speeds human teams alone could never match. In a business climate marked by uncertainty and high borrowing costs, CFOs say real-time insights gleaned from these tools are crucial to stay one step ahead. The mood is cautious, but optimistic. Corporate treasury teams are finding they can offset rising financing expenses by smartly investing idle funds, turning what used to be stagnant cash piles into valuable war chests that bolster growth and resilience. This technological evolution comes alongside a cultural shift. Corporate treasurers are stepping forward as key strategic partners across their organizations. No longer pigeonholed in the back office, top treasury executives are now deeply involved in company-wide planning and enterprise risk decisions. They work hand-in-hand with CEOs and boards to evaluate investment opportunities, manage currency exposures, and support expansion moves. At a finance leadership summit this week, industry voices underscored that a modern treasury's influence extends to everything from pricing strategy to supply chain agility. This elevated role has pushed treasurers to develop new skills in data science and scenario planning, reinforcing their value in the C-suite. As one CFO put it, Treasury is evolving from spreadsheets and hindsight to simulations and foresight, delivering judicious guidance that can help companies thrive amid volatility. Subtopic: Legal/e-commerce angle. Corporate treasurers in e-commerce-driven companies are also navigating new legal challenges as digital marketplaces handle ever-larger flows of customer and merchant funds. Regulators, concerned with protecting participants, are tightening oversight of how online retailers manage third-party seller payments and customer balances, sometimes treating these platforms almost like banks. In some jurisdictions, laws now require marketplaces to hold client monies in segregated accounts and meet strict money transmission and consumer protection rules. One high-profile case saw a global e-commerce marketplace face regulatory scrutiny and legal action for delaying vendor payouts, underscoring the fiduciary duty platforms owe to their merchant partners. The legal pressure is prompting e-commerce CFOs to reinforce cash management controls in line with regulatory best practices, ensuring every transaction is transparent, safeguarded, and swiftly settled. These moves have spurred innovative solutions like automated escrow accounts and blockchain-based fund tracking to strengthen trust in the e-commerce ecosystem while keeping platforms firmly on the right side of the law. In enterprise risk management, news, companies are doubling down on integrated risk strategies after a series of global wake-up calls. This week, a widely used enterprise software provider confirmed a major security breach that exposed client data through a long-undetected vulnerability, sending ripples through corporate IT and risk teams worldwide. The incident comes on the heels of other high-profile shocks, from a sudden mid-sized bank failure last year to geopolitical flare-ups snarling supply chains, underscoring how unpredictable today's risk landscape has become. In response, boards and CEOs are leaning on chief risk officers, CROs, and their teams for vigilance and foresight like never before. The once backstage function of risk management has moved center stage in many organizations, with CROs now regular fixtures at strategy meetings. Each unforeseen event reinforces a common theme. Risk management isn't a mere cost center, but a critical guardian of corporate resilience and an enabler of stability and growth. To cope with fast-evolving threats, risk teams are deploying advanced analytics and AI to spot trouble before it strikes. Across industries, next-generation risk platforms churn through vast data streams, market indicators, supplier metrics, emerging hacker tactics, even weather patterns, to detect anomalies and early warning signs. In practice, algorithms might pick up subtle anomalies, an unusual payment pattern hinting at fraud, or a bottleneck forming in a supply chain, and alert leadership within minutes. Companies are also ramping up stress testing and scenario planning, running continuous simulations for events that once seemed remote, from social media misinformation storms to abrupt regulatory shifts that could upend business models. Risk experts say success now hinges on being proactive, not reactive. By blending real-time data with human judgment, organizations aim to prevent crises rather than scramble after them, potentially saving money, reputation, and even lives. A risk-first culture is quickly becoming a hallmark of forward-looking enterprises. Companies are training employees at all levels to think like risk managers, building resiliency into every new project from the start. This evolution has spurred closer collaboration between finance and risk divisions, integrating risk appetite considerations into everything from product launches to major investments. Regulators, for their part, are encouraging these developments by pushing for greater transparency and accountability in how risks are disclosed and managed, essentially setting higher expectations that organizations embed risk thinking into daily operations. Despite the serious nature of their work, today's risk leaders often convey a sense of determination and cautious hope. They see their efforts as not only protecting assets and meeting compliance requirements, but also empowering businesses to innovate with confidence, even eyeing bold ventures, like perhaps an orbital supply chain one day, knowing robust safeguards are in place. will never eliminate uncertainty, but it is providing companies and their stakeholders a much-needed compass to navigate an increasingly turbulent world. Subtopic: Legal/e-commerce angle. The crossroads of risk management and e-commerce is drawing particular scrutiny in the legal arena. As massive online retail platforms grow global supply chains and handle sensitive consumer data, regulators are mandating stronger risk controls to ensure these digital marketplaces remain safe and reliable. In the European Union, for example, new digital regulations require large e-commerce platforms to regularly assess and mitigate risks, from algorithmic manipulation to cybersecurity vulnerabilities, with the aim of protecting consumers and honest sellers. In one recent case, an e-commerce giant faced a regulatory inquiry after a cluster of fraudulent sellers slipped through its defenses, prompting calls for stricter marketplace risk oversight. Increasingly, legal compliance goes hand in hand with operational risk strategy in online commerce, from vetting third-party merchants and monitoring product safety to safeguarding customer information under evolving privacy laws. The message is clear: effective enterprise risk management is no longer optional in digital commerce, but rapidly becoming a legal obligation as authorities demand that e-commerce companies build resilience and accountability into their operations. In B2B payments and infrastructure FinTech news, the long-awaited modernization of business transactions is arriving in force as companies demand faster, smarter ways to move money. For years, business-to-business payments lagged behind consumer FinTech advances, clinging to paper checks and slow bank wires. But 2026 is shaping up as a turning point. Firms now expect instant, low-cost payment options across borders and platforms, as seamless as sending a payment on a mobile app. Banks and fintech firms are racing to deliver on that expectation. Just this week, Bank of America unveiled a new real-time international payment service enabling corporate clients to send funds overseas in seconds via local instant payment networks. Set to launch next quarter, it specifically targets modern use cases like gig worker payouts and e-commerce vendor disbursements, offering 24/7 access and no hidden fees. In short, even the largest incumbent banks are embracing the push for nimble, always available B2B payment capabilities to keep pace with a fully digital, globally connected economy. Meanwhile, consolidation is accelerating among specialized fintech players as they vie for a larger slice of the global B2B commerce pie. In a headline-grabbing development, Canadian payments processor Nuvei is reportedly in advanced talks to acquire US-based cross-border paytech Payoneer for roughly $2.7 billion, according to sources cited by Reuters. Payoneer's platform is a lifeline for millions of marketplace sellers and small exporters around the world to get paid securely in their local currency. Combining Payoneer's deep e-commerce merchant network with Nuvei's broader payment technology portfolio could create a unified powerhouse for cross-border business transactions. Sources suggest an agreement could be finalized within days, a clear example of how leading companies are bulking up to meet soaring demand for seamless international B2B payments. Notably, Payoneer has been pushing the innovation envelope by seeking regulatory approval for a USD-pegged stablecoin and a special banking charter in the US, signaling that the future of B2B payments might blend traditional finance with the efficiency of blockchain. These developments fit into a broader narrative. The once sleepy B2B payments sector is now a hotbed of innovation and competition. Across global tech hubs, both startups and established firms are rolling out cloud-based platforms, API integrations, and even tokenized payment solutions to transform how companies pay their suppliers and manage receivables. Real-time settlement means small vendors can now receive funds immediately upon delivery, boosting their cash flow and reducing credit risk. Automated workflows and predictive analytics are cutting down manual reconciliation headaches and errors that used to plague corporate accounting departments. Industry leaders describe the modernization of B2B payments as a massive opportunity to free up working capital and open new markets for businesses of all sizes. Some even muse that one day these networks might extend beyond Earth, perhaps facilitating instant payments between a lunar mining outpost and its Earth-based contractors, underscoring the ambition fueling today's infrastructure upgrades. For now, though, the focus remains firmly on earthbound commerce, making global B2B payments as frictionless and speedy as swiping a phone, empowering companies everywhere to thrive in a truly borderless marketplace. Subtopic: Legal/e-commerce angle. Regulators worldwide are also pushing digital B2B payments forward through new legal mandates in the e-commerce realm. Across many countries, authorities are introducing rules that essentially force businesses to upgrade how they transact and report finances online. For example, in the European Union, multiple nations are phasing in requirements for electronic invoicing and real-time tax reporting on cross-border sales, aiming to clamp down on VAT fraud and streamline digital commerce oversight. Large online marketplaces now must provide tax authorities with detailed transaction data, and some jurisdictions levy steep penalties on companies that fail to modernize their invoicing and payment systems by set deadlines. In the United States, policymakers are exploring updates to commercial payments regulations, including clearer guidance on digital assets and stablecoins for business transactions. These legal shifts go hand in hand with innovation. Companies are rapidly adopting compliance-friendly payment tech, from integrated e-invoice portals to blockchain audit trails, to meet the new standards and gain an edge in the digital trade boom. The line between regulatory compliance and fintech adoption in B2B e-commerce is blurring as governments and industry together drive business payments fully into the digital age. In regulatory technology, RegTech, news, artificial intelligence, and automation are revolutionizing how companies adhere to complex rules. From anti-money laundering crackdowns to data privacy mandates, the corporate compliance burden has swelled so much that human teams, by themselves, can barely keep up. After a decade in which global banks paid billions in fines for compliance failures, financial institutions are now investing heavily in smarter systems to catch problems early and ensure nothing falls through the cracks. Many banks and fintech firms have deployed machine learning algorithms to monitor transactions in real time and flag suspicious patterns for human review. Others use advanced data analytics to scan internal communications and trading patterns for signs of misconduct that traditional oversight might miss. Even regulators are getting tech-savvy. Watchdog agencies have begun using their own AI tools to comb through market data and social media chatter, hoping to spot fraud or systemic risks before they escalate. This all marks a paradigm shift. Compliance is moving beyond checklists and after-the-fact audits, evolving into a regime of continuous, tech-enabled vigilance. One RegTech domain advancing rapidly is identity verification and Know Your Customer (KYC) compliance. Processes that once required piles of documents and days of back and forth are now often completed in minutes using biometrics and big data. Banks and crypto exchanges report that AI-powered ID checks and risk-scoring algorithms have slashed onboarding times for new clients while strengthening fraud detection. Regulatory reporting is also being transformed. Software can consolidate data from across an organization and automatically format it to each regulator's exact specifications, reducing the risk of human error. Some firms are even experimenting with blockchain ledgers to create tamper-proof records of compliance tasks and audit trails. Though these innovations raise questions about algorithmic transparency and data privacy, industry leaders are cautiously optimistic. They argue that RegTech isn't just cutting costs, it's also improving accuracy and building more resilient, trustworthy financial systems. As RegTech goes mainstream, collaboration between regulators and industry is intensifying to ensure new tools are effective and safe. Governments and central banks are launching innovation hubs and regulatory sandboxes where compliance technologies can be tested under supervision. Internationally, regulators are sharing best practices. European authorities, for instance, are drafting guidelines to ensure AI-driven compliance systems respect privacy and fairness standards, while U.S. agencies are consulting tech experts to modernize their own oversight approaches. The end goal is to harness innovation without sacrificing accountability. Implemented correctly, RegTech promises to make markets more transparent and secure, bolstering public confidence in the financial system. Some analysts even say the compliance frameworks being built today could form the foundation for policing commerce in new frontiers, from global digital currencies to future off-world trade, proving that effective regulation and high technology can indeed go hand in hand. Subtopic: Legal/e-commerce angle. E-commerce platforms are increasingly turning to RegTech solutions to meet new legal obligations and curb online fraud. In the United States, the Informed Consumers Act now requires large online marketplaces to verify and disclose the identities of high-volume third-party sellers to deter the sale of stolen or counterfeit goods. This mandate forces digital retailers to implement automated ID verification checks and stricter seller vetting processes to remain compliant. The European Union's Digital Services Act similarly compels e-commerce companies to patrol their platforms for illegal products and content using advanced monitoring systems. Regulators across multiple regions are aligned in expecting online marketplaces to know who is operating on their sites and swiftly remove any unlawful listings. To meet these mandates, industry leaders are adopting AI-driven solutions, from merchant due diligence algorithms to image recognition tools that catch counterfeit goods, as part of their compliance arsenal. The result is a safer e-commerce environment with improved trust for consumers, as companies embrace RegTech to satisfy global standards. Finally, in institutional trading and market infrastructure news, the architecture of the world's financial markets is undergoing fundamental upgrades to become faster, more efficient, and more accessible around the clock. A key development is the global acceleration of trade settlement cycles. After the United States, Canada, and others transition to T+1, one business day, settlement for securities last year. Other markets are quickly following suit. On June 1st, Nigeria's stock exchange moved from a T+2 to T+1 settlement cycle, aligning itself with the world's most advanced markets and highlighting a global push for speed. The change initially caused some teething pains. Foreign investors temporarily pulled back to observe how the new framework would affect liquidity. But experts say such adjustments typically give way to long-term benefits like reduced counterparty risk and lower capital costs for market participants. With Europe and parts of Asia also evaluating shorter settlement timelines, the once slow back end of trading is catching up with the high-speed front end, making markets sturdier and more adaptable. At the same time, calls for near 24/7 trading are growing louder. Major exchange operators have been quietly laying groundwork for significantly extended trading hours, recognizing that a globally connected market never truly sleeps. In fact, U.S. exchange groups have gained regulatory approvals to lengthen trading sessions dramatically. One leading exchange aims to operate 22 hours a day by late 2026, and the industry is planning for 24/5. Equities trading, Sunday evening through Friday evening continuously, with brief nightly breaks, as a feasible reality within the next year or two. Success in this venture hinges on infrastructure alignment. Clearinghouses, trading systems, and market data providers are all upgrading their technology to handle a near-continuous flow of trades. Already, off-hours volume is on the rise as investors in Asia and Europe increasingly demand access to U.S. stocks beyond the old 9:30 to 4 o'clock window. Market watchers say it's no longer a question of if, but when. Global markets will operate on an almost around-the-clock basis, gradually erasing the traditional boundaries of geography and time. To make these visions possible, market infrastructure players are turning to cutting-edge technologies. Exchanges and clearinghouses are experimenting with blockchain and distributed ledger platforms to speed up post-trade processing and even enable atomic, instant, settlement of trades in the future. Some central banks and large financial institutions are piloting tokenized securities and digital cash for settlement, which could one day enable truly T+0, same-day, or even real-time settlement of stock trades. Meanwhile, trading firms are incorporating more AI into their operations for everything from algorithmic market making to predictive analytics that help manage risk in extended hours. The big-picture benefit of these innovations is a safer, more inclusive market. Shorter settlement cycles reduce risk and free up capital. Extended hours give investors worldwide equal opportunities to react to news. And advanced analytics improve oversight to detect anomalies in fast-moving electronic markets. Some forward thinkers even speculate about future financial exchanges spanning Earth and space, envisioning a time when not just our planet, but multiple planets' economies trade seamlessly on a unified infrastructure. For now, the emphasis is down to earth, modernizing market plumbing to ensure that institutional trading is faster, fairer, and more future-proof than ever. Subtopic: Legal/e-commerce angle. As e-commerce platforms adopt advanced pricing algorithms reminiscent of stock trading, regulators are cracking down on algorithmic pricing to ensure fairness for consumers. In China, new rules took effect in April banning unfair algorithmic pricing practices on major e-commerce sites. These internet platform pricing conduct rules forbid platforms from abusing algorithms to discriminate between customers, for example, charging returning buyers more, or from forcing merchants into lowest price agreements that distort competition. European and U.S. regulators are also ramping up scrutiny of algorithm-driven pricing in online retail, probing whether automated price setting might amount to collusion or unfair manipulation. Experts draw parallels to high-frequency trading regulations in finance, highlighting that as e-commerce marketplaces become more like open markets, they too face oversight similar to anti-manipulation rules in securities trading. By demanding transparency and accountability in how online prices are determined, authorities aim to protect consumers and preserve a level playing field for merchants. The implication is that as digital commerce evolves into a market-like environment, it will increasingly encounter market-style regulations designed to rein in algorithms and uphold fair competition. Disclaimer: the information presented above is news and analysis only, not legal, financial, medical, or official advice. Readers and viewers should not interpret these stories or the examples given as guidance for personal or business decisions. All content is for informational purposes, and any actions taken based on it are at one's own discretion. Always consult certified professionals for advice on financial, legal, medical, or regulatory matters. Remember that news stories and anecdotes reflect current events and expert commentary, not instructions or guarantees, so they should not be treated as actionable advice. Video tagline: Today's FinTech Frontiers, from CFOs going cosmic to markets that never sleep. Video description: Get up to speed on 5 major shifts transforming finance and market infrastructure today. We cover how CFOs are harnessing AI and high yields to strengthen corporate treasuries, why enterprise risk managers are stepping into the spotlight with proactive strategies, and how B2B payments are finally going real-time and global amid big fintech deals. Plus, learn how regulators and RegTech are teaming up to make digital commerce safer, and why stock markets worldwide are gearing up for faster settlements and near 24/7 trading. This in-depth briefing blends today's top headlines with a futurist twist, exploring changes on Earth that could even shape the commerce of tomorrow in space. Nothing in this report is advice, just the news and insight you need to stay informed. Video tags: FinTech, corporate treasury, cash management, CFO strategies, enterprise risk management, risk analytics, B2B payments, cross-border payments, FinTech M&A, stablecoin, RegTech, compliance technology, AI in finance, digital identity, e-commerce regulation, algorithmic pricing, digital marketplace, institutional trading, market infrastructure, T+1 settlement, 24/5 trading, blockchain in finance, tokenization, financial innovation, future of finance. Base thumbnail concept: a dynamic collage-style image split into 5 sections, each depicting one of the topics in visually striking ways. For example, a CFO silhouette with AI graphics and dollar signs, a shield icon over a globe representing risk management, a network of connected payment nodes for B2B fintech, a gavel combined with a circuit board symbolizing RegTech, and a city skyline merging into a digital stock chart for market infrastructure. The overall color scheme is high-tech and optimistic, with bright blues and golds, and a faint silhouette of Earth against a starry backdrop to hint at future horizons. A, B/C thumbnail variants. Variant A, Futurist Finance Theme. A futuristic cityscape with skyscrapers blending into upward trending graphs and an overlay of a network grid, plus a tiny rocket or satellite in the corner suggesting the space economy angle. Bold text highlights finance frontiers over the image, grabbing viewer attention. Variant B, Human and Tech Theme. A composite close-up of a businessperson's face half overlaid with circuit patterns, symbolizing human-centric innovation. Surrounding elements include currency symbols, a globe, and a stopwatch to imply speed and time in markets. This design emphasizes the human and hopeful aspect behind technological change. Variant C, News Mosaic Theme. A thumbnail styled like a collage of mini-scenes, a bank vault with coins, treasury, a fingerprint scan, KYC compliance, a robotic hand shaking a human hand, AI partnership in risk, and a stock exchange floor merging into a cosmic starscape, markets reaching new frontiers. Each scene is tinted in different bright colors, creating a vibrant mosaic effect that instantly conveys multiple topics and a cutting-edge vibe.